Okay, we are diving right in. We've got a huge story that could impact, well, pretty much everything from like what you buy online to, global markets. And that is this big announcement, this 54% reciprocal tariff that just hit goods coming into the U.S. from China.
Yeah, this is not just another headline. This is a real escalation in trade, and for anyone who wants to understand, where the economy is headed, this is something you really got to get a handle on, and that's what we're going to try to do right now.
Yeah. I mean, look, we all know you're busy. You need to get to the heart of this without getting, bogged down in endless news cycles and all that. So we did a deep dive into some investor focus analysis. This is from the Motley Fool, and we're going to try to extract the key insights for you. And our mission today is to really figure out what these tariffs might do to China's economy. How could they reshape, U.S. imports, especially the whole e-commerce scene, which is just booming right now, and what kind of shifts might we see in how investors are looking at Chinese stocks, particularly companies like PDD Holdings, the parent company of Pinduoduo and Temu.
Yeah. I think we got to start with the announcement itself and the immediate reaction we saw in the markets, right? And the Motley Fool analysis makes it clear that this 54% tariff, it's not totally a new burden, right? It incorporates a 20% tariff that was already in effect, but still, I mean, that's substantial.
Right. It's like the sheer size of this tariff that got added on top really seems to have caught investors off guard. As the article points out, U.S. stocks, they took a pretty significant hit on the news.
Right.
But what's really interesting is how Chinese stocks reacted. Like the iShares MSCI China ETF, which is basically, if you're not familiar, it's a basket of major Chinese stocks.
Right.
That ETF, it only saw a small drop, like 0.9%, on that Thursday, April 4th, 2025. So I mean that's a pretty stark contrast.
Yeah, it's definitely different, and it plays into a bigger trend that the analysis touches on, which is that international stocks overall, they've actually been doing better than U.S. stocks this year.
Right.
And one of the key reasons they cite for that is this this whole trade war, that the exposure, international stocks are less directly exposed.
Yeah.
There's also weaker U.S. consumer confidence, and you got to remember that international stock valuations, they were lower on average coming into the year. Chinese stocks, especially, some people were looking at them as being pretty cheap.
Right.
So I think that the big takeaway here is maybe like a potential turning of the tides. You got international stocks showing some surprising strength even before these tariffs really, really hit.
Which leads us to the next piece of the puzzle, which is how's this gonna hit the Chinese economy itself? I mean, we're talking about 54%. That's a pretty sizable tariff. What does the analysis suggest is kind of how this might play out in China?
Well, one thing that could happen is, an acceleration of a trend that's already been happening. The article mentions, companies like Nike, they've already started shifting some of their production out of China. Vietnam being one example to try to get around some of these earlier tariffs. And, now with this really significant increase, well, it could definitely, push more businesses to really start looking at diversifying their supply chains, maybe moving production to countries with lower tariff rates, or even back to the U.S.
Makes sense. If the cost of bringing stuff in from China jumps up that much, suddenly other places where you can make stuff start to look a lot more appealing.
Yeah.
The article also drops this really, really big number, $438.9 billion. Mm-hmm. That's how much. That's the value of goods that the U.S. imported from China in 2024. So you get a sense of the scale here, the sheer volume of stuff that's now facing these much higher costs.
Absolutely. And what the analysis suggests is this could, it could further weaken the Chinese economy, which, was already dealing with some challenges, right? If Chinese goods become, way more expensive in the U.S., we could see demand drop. And and we can't forget that China has said, they're gonna put their own tariffs in place in response. So, this kind of back and forth, trade war situation, it creates a lot of economic friction for both sides.
And to bring it back to those e-commerce giants we were talking about, like PDD Holdings, the parent company of Pinduoduo and Temu, if the Chinese consumer starts to feel more economic pressure, that's got to have some ripple effects on how they perform in their home market, right?
Absolutely. I mean, consumer spending, that's the engine of growth for e-commerce, right?
Right.
So if the overall economic picture in China starts to weaken, people are going to have less money to spend, less discretionary spending, and that could really slow down the growth of these online platforms inside China.
Okay, so let's kind of zoom in on how this hits the U.S. specifically, our imports and what PDD Holdings is doing here. The article points out that PDD Holdings, the company itself, they don't actually break down their revenue by specific regions.
Right.
But it's pretty obvious that they've made a big aggressive push into the U.S. market with Temu, their platform that's known for low cost goods, right?
Mm-hmm.
Yeah, exactly. Temu's really, their active marketing, their focus on really competitive pricing, it's definitely shaken things up in the digital ad space here. They've managed to grab a pretty noticeable share of the market, attracting customers who, in the past they might have been shopping with, some of the more established e-commerce companies or even just, brick and mortar stores. I mean, we've even seen Amazon respond, right? They came out with their own kind of budget focused platform called Haul, which really tells you how much of a competitor Temu has become in such a short time.
Yeah, it's amazing. And to put some numbers around all this, PDD Holdings, they brought in $54 billion in revenue in 2024. But the article makes this really important distinction. Their gross merchandise volume, or GMV, think of that as like the total value of all the stuff sold through their platform. Yeah. It's probably way bigger than that $54 billion revenue number.
Right.
The analysis suggests their U.S. GMV, it could already be billions, multiple billions of dollars. So it's like if revenue is $54 billion, the actual value of the goods that are moving through their platform, it's even bigger. Why is that distinction important? Why should we care?
Well, because, revenue for PDD, it mostly comes from the fees they charge and the advertising on their platform, right? Yeah. The GMV, that represents the total value of all the transactions. So a big GMV, it tells you about the scale of their operation, how much influence they have on the market. Even if, their direct revenue from those sales, it's a smaller percentage. Mm-hmm. It's about how much stuff is flowing through their platform, which is what attracts advertisers. They want to reach those consumers.
Right.
And as our article points out, advertising, that's PDD Holdings' biggest revenue source, right?
Okay.
So they really depend on those advertisers being confident.
Right.
And that confidence, it depends on consumers actually, spending money on Temu.
Yeah, that makes sense. So let's shift gears a little bit here and think about how this tariff news might be affecting how investors here in the U.S., how they're looking at Chinese stocks. Yeah. The article points out that even before this announcement, some investors, people like the billionaire David Tepper, well-known investor, they were starting to see some value in Chinese stocks. They thought they were undervalued compared to U.S. stocks.
Yeah, absolutely. That lower price tag on a lot of these Chinese stocks, it was starting to look pretty good to investors who are looking for opportunities outside the U.S. market. And here's a really interesting point that the article makes, maybe even a little counterintuitive, which is that if these tariffs actually lead to a slowdown in the U.S. economy, or even a recession, PDD Holdings, even though they're a Chinese company, even though they're facing these tariffs on their imports, they could actually benefit.
Okay, now this is an angle I didn't really think about. How could a company that's facing higher costs to get their stuff into the U.S., how could they actually see a benefit from the U.S. economy kind of taking a downturn?
Well, the thinking is that, PDD Holdings and Temu especially, they're known for those really low prices, right? Like rock bottom prices. And so if we hit an economic downturn, American consumers, they're going to be pinching pennies. They're going to be looking for the most affordable options.
Right.
And because Temu has already kind of positioned itself as that budget-friendly place to shop, well, they could become even more attractive, right? When people are really trying to stretch their dollar.
Right.
The analysis also points out that, PDD Holdings, they're a pretty popular Chinese stock among American investors, right? So we might see more people getting interested in investing in them if things start to slow down, like looking for those potential winners even during a downturn.
It's an interesting possibility for sure.
Yeah.
The article also reminds us about PDD Holdings' recent performance. They had a a pretty strong revenue growth, like 24%, that they reported in the fourth quarter. And that actually beat the growth of some of the other big players in the Chinese e-commerce space.
Right.
Companies like Alibaba and JD.com.
Yeah, right. They've shown that they can grow, even in a really competitive market.
Right.
And then you look at their price to earnings ratio, it's only 11, as the article points out. So, just from a pure kind of, fundamental valuation standpoint, they look pretty attractive, especially compared to a lot of U.S. companies.
Okay, so to sum it all up, what are the key things you want our listeners to take away from this deep dive that we did into this Motley Fool analysis?
Well, first off, we're looking at a big jump in tariffs on goods coming from China into the U.S., right?
Yeah.
And that has the potential to really hurt the Chinese economy, and it could speed up that trend of companies, moving their production to other countries.
Right.
For PDD Holdings specifically, and the company behind Temu, they've got a lot riding on the U.S. market. And while these tariffs, they could definitely increase their costs, their whole strategy of offering those super low prices. It might actually make them more attractive to U.S. consumers if the economy slows down. Kind of strange how that works. And then those lower valuations on Chinese stocks, including PDD Holdings, and you combine that with these changes in the economy. Well, it could mean that we see more U.S. investors getting interested in Chinese companies. They might be looking for value and for growth.
Right.
Outside of the U.S. market.
Right. So as you're taking all this in, it's clear that this whole tariff development it's a big piece of the bigger puzzle of global trade and investment, right? And it really shows how interconnected our economies are.
Absolutely.
And considering that, we might see higher prices on imported goods, we might see consumers, changing their behavior, looking for cheaper options. And then there's that interesting possibility of more investment flowing into Chinese stocks. Even though they're the ones that are kind of in the crosshairs of these tariffs, it leaves us with a final question to think about. Given this whole tangled web of global economies and consumer tastes that are always changing, how might these tariffs really reshape the whole landscape of online retail and international investment in the years to come? That's something to keep an eye on for sure. Thanks for taking this deep dive with us.
Yeah, thanks for having me.
You got it.